On Wednesday, President Obama is expected to sign into law the most sweeping overhaul of the financial industry since the New Deal. The Senate passed the bill last week. However, just 3 Republicans voted in favor of the measure. The president says the bill is essential to the nation's economic recovery, while opponents argue it would create more problems than it will solve. So what exactly is in the bill? Well, here to help us understand what's included and what it means for you is Kelli Grant. She's senior consumer reporter for smartmoney.com. Kelli, thank you for joining us.
Good morning.
Help us understand what is in this bill.
I mean, the overall impact is going to be targeted to banks and other businesses, but for consumers, the hope is that you're going to benefit from the overall aim of the bill, the more stable financial system. And the idea here is that some of the tenets in place would prevent a financial collapse along the lines of the big failures and bailouts we saw in 2008 and 2009. But of course, critics say this is going to cause a lot more problems, and if anything, it's just going to prevent one specific way the system might collapse. There are endless number of other ways that it could happen.
I know this has kind of been a little bit of a step-by-step process. We had the credit card, the Card Act last year, which kind of helped consumers in that sense. Is this going to create a whole bunch of little agencies to kind of police different products?
Well, there is going to be one new protection bureau. It's the Consumer Finance Protection Bureau, and that's going to oversee a lot of these consumer financial products, notably credit cards and mortgages. And the aim is going to be to have things like the Card Act. If they notice a problem that they can act faster, then Congress would be able to alone. But already we've seen a lot of industries have petitioned to be excluded from coverage on the bureau, notably the auto dealerships, which will retain coverage under the FTC. So not everything's going to be covered here, which could mean you're still going to see a lot of problems in a lot of industries.
People are already looking for the outs.
They are, and there's some definite loopholes for them to work with.
Does this mean fewer bailouts? Like when the federal government had to bail out the big banks, does this mean that with other businesses as well?
It may. Regulators are going to be given more control to take over and close down ailing non-bank businesses. It's similar to what the FDIC does. They would take over a failing bank and liquidate its assets. And in this case, all of the funding for that liquidation would come from the financial industry instead of a direct bailout from taxpayers. But of course, as we've seen even with the Card Act, these businesses do have ways of making the consumers foot the bill. We're seeing already with some of the new credit card protections that consumers are seeing more checking account fees for them to make up for that revenue lost.
Right. They're already increasing things there to kind of cover themselves.
Exactly. So don't think you're not paying for this. It's just going to be a little more indirect.
And how about a tighter mortgage market? Mortgages have been changing.
They have, and in this case, part of the bill is a restructuring of mortgages from basically top to bottom, from what products are offered to how they're funded. And people are already reporting that mortgage lenders are looking more closely at borrowers' assets. They really want to see a lot more paperwork and qualifications about your assets and income. And that's something that new applicants might see higher rates, especially if they don't have stellar credit or they don't really fit what these lenders are now looking for.
Yeah, now you have to prove how much income you're making, all different things like that.
Exactly, and if you were looking for something that might have been initially a more exotic mortgage, that's going to be much, much harder to find now, so you're going to see that's a very expensive proposition to get.
And as part of this sweeping financial reform, there might be more help in a way. People kind of now have to explain to you how it works for you.
If you have been working with a broker-dealer, basically now the Securities and Exchange Commission has the right to form a regulation basically involving these broker-dealers now have to reveal to you whether something that they're selling you is actually in your best interest. They have to work in your best interest, and they have to reveal whether there's anything in it for them. So any conflict of interest, usually they don't have to reveal whether they're getting commission paid on a particular investment, and now they're going to have to do that, and they're going to have to make sure that this product that they're recommending is actually a good one for you.
So all we're waiting now is the president's signature, correct?
Pretty much, and of course we'll see probably some more reform down the line.
Okay, Kelli Grant from smartmoney.com. Thank you for joining us.
Thank you.